Okay, it's called demand core. And if you look at the requirements for this, they are saying calculate incremental profit or loss per component of the group. Division M accepts the new supplier's offer and recommend how components Division L should sell. How many they should sell to Division M if the group profits are to be maximized. And then using quantities calculated in A and the current transfer price, calculate the total annual profits of each division and the group as a whole, and then discuss the problems which will arise if the transfer price remains unchanged and advise the divisions on a suitable alternative. So that's what they're asking for. And then, of course, now they say that this manufacturing company, Manco, has two divisions, Division L, Division M. They both make a single standardized product. Division L makes component L, which is supplies to both Division M and external customers. Division M makes the product M using 1 unit of component L and other materials. It then sells the completed product to external customers. So right now, Division M has always bought component L from Division L. So they are now comparing here. They have the selling price. So this is how much component L is sold. And then product itself is sold at 96. Then for materials, of course, they are selling it at 40 to Division M. So that's why this is the same amount. So the question now you need to know is whether they sell this at the same amount to the external people. And then also I'm going to explain to you what material transfer pricing is all about. Then they have other costs, direct labor. We have 12 for component L. Then here 17. Then we have variable overheads. Then we have selling and distribution costs. And then also we need to know whether these ones are incurred when you sell to company, to Division M, or if they are the same that are incurred when you are selling to external people. Our contribution is here before the fixed costs. And then, of course, they start talking about the fixed costs, which include 500K for component A and then this one for M. Then we have external demand, 160,000 and 120,000. And then the capacity is 300,000 and 130,000 for product M. It means that Division L can make 300,000 units. This one is 130. It can make 130, but it has demand of 120. So it means that it doesn't have to, they don't give it the entire 130, but rather 120. And if you give it 120, that means it remains with 180. And the annual external demand is 160. So looks like you still have enough capacity to supply both the external customers, but also product M. So some of those things I'm hinting about, we are going to discuss them later on, but it's always good to pick them up when you are reading. So they're saying Division L charges the same price. So we have answered one of the questions we asked ourselves. So it charges the same price to company for Division M and also external suppliers, external customers for this component. But it doesn't incur selling and distribution costs when it transfers internally. So this other question has been answered. Then now there has been another company, a new supplier, who has approached Division M and is trying to supply it with component L for 37 per unit. Before this, the cheapest price which Division M could have bought component L would have been 42 per unit. So we shall have to compare how much they would be willing to pay for it and whether they should be buying from the organization, from the division itself. And also, actually now there is this important line here that it is the head office policy to let the divisions operate autonomously without interference at all. So what this means is that division M can decide to buy from outside as opposed to actually buying from division A or debt component. So that is what this information given to us is saying. And now what we have to first of all do is to basically have a small introduction of what transfer pricing is all about. So transfer pricing, basically we are looking at the price charged between related transfer pricing or transfer price, the price charged between related parties. So in this case, the most common that you're going to find, at least in performance management, is just about divisions. But you can imagine so many other things can happen. You can imagine that you have a company which is a group of companies which has subsidiaries. Then you can imagine there is another company here which is not related to this. So now, transfer pricing relates to if company A were to sell things to company C, or company A were to sell things to company D, or company C were to sell to company D. Now, this is transfer pricing. Because ideally what you are saying is that, when you compare the profits of the whole group, because here, when you sell, you put here your money that you have sold for 5,000. That will be revenue. But the person that you sell to will come here and record an expense of the same 5,000. So when you consolidate books, everything that has happened within the group cancels out. Because if you have a revenue here, you have an expense here, which cancels it out. So as far as the group is concerned, there is no effect on the group profits. So, and I don't know if you have already looked at this in financial reporting or financial accounting, but it's something that is mentioned there, that when you have group statement of accounts, you normally cancel out the intra-group transfers, things that have to do with the receivables, payables, things that have to do with the sales and purchases, things that have to do with loans. So those things, all of those cancel out when you are dealing with the group. The only thing that matters is how much has been sold externally. So here, this is the only thing that matters for the group. Now, that's for a group perspective. However, for an individual company within this group, when they are preparing their books of accounts individually, this company here will record revenues, report expenses, and get profit or a loss. And for this one, it matters how much they sold these things, and so on and so forth. So that's the idea. Now, when you say the group has made a profit of 5 million, you could have put that profit in just company A, where leaving these two companies making losses, which is something that has tax implications, but this paper is not about tax. It's just about responsibilities. If you have a profit center as this division, then it matters that you should be appropriately rewarded for what you have done. So you don't have to just take out all the expenses of the company within this division and reporting a loss when you should have provoked a profit. So it's about charging some price which is fair. So we have to talk about fairness when we are discussing transfer pricing. Fairness. So that's what we are going to actually try to answer when we look at this question. So now that is a small introduction of the whole concept. Now we go back to what the question is asking us. It's saying incremental profit or loss per component of the group if division M accepts the new supplier's offer, and recommend how many components division L should sell division M if group profits are to be maximized. So when you want to maximize group profits, here you are still not worrying about you're still not worrying about the division as a whole. So now, as we come here, we can try to look at the incremental profit this way. So remember, right now we are buying component L at 40, but this company wants to give it at 37. Okay, so it means that when we buy from external, we shall have some saving. Now the question is, if I buy from external, I lose these sales, 120,000. Remember, I have capacity of making 300,000 units, and I've been able to sell externally and also to the what? To division M. So that means that if I lose division M, I have lost 120,000 units. So what you do, so you first look at the saving, okay, which I make if I actually if product M or if division M buys from externally, then you look at that saving. Then also you look at the cost that I actually, they say the loss that I'm making. So now, how much have I incurred to make this component L? I have 12 direct labor. I have 6 variable overheads. Then I have 2. So that is the setting, and this is okay. Let me see the way they are. Setting and distribution is 4. Variable overhead is 2. Direct labor is 6. And then the other costs, okay? For you to make component L, there are other costs that are involved. So the materials themselves. So now it means that for me to sell this component L, I incur 12 plus 6 plus 2 to sell to M. Remember, they say that we don't incur the selling and distribution costs. So that means that we are incurring 20. We are incurring 20. So it means, as far as the group is concerned, this is what will happen. For the group, we shall have this, like, because if we buy from outside, they'll charge us 37. So that is going to be a saving, but we would have incurred, like, the group will not make the product. So the group will save as we said, 16 plus 12 plus 6 plus 2. So it will save $20. If not make component, if you don't sell component L to division M, okay, because if the division M is buying from outside, then it means that we shall not make those units. So we shall save, this is actually not, this is per unit, okay, per unit. But then the company now will incur 37 to buy from outside. Okay, so that's how it will work. That if the group as a whole, or if the company as a whole decides to now use components from external for division M, it means that we shall be incurring that 37, because remember we said that whatever happens within the company cancels out. But now the 37 will be coming from outside, so we shall incur it. And then because we are not making those components, then we shall also save that $20. Therefore, the incremental cost here is just 37 minus 20, which is 17. That's the incremental cost for the group. Remember, we are referring to the whole company now, the whole group, 20. So now that is the incremental cost. And the question asked us to calculate incremental cost, profit or loss. So now this is the incremental cost. And then they're asking us and recommend how many components division L should sell. Now, because division L has the capacity to produce 300,000 and the demand is only 160, it means that it should sell all of the 120 to division M. So the best course of action for the company or for the group in this case is for division L to sell all the component, or the 120 component L needed by division M. So it means that here division the company is not benefiting from buying out from outside actually. So therefore they should actually just keep doing what they have been doing. They supply component L from division L to division M. That is for as far as the group is concerned. Okay. But as we said, as far as the individual entity is concerned, then there's a different story. And that's what I think they're asking us for the second part, to look at the total annual profit of each division and the group as a whole, using the quantities in the current position. So now what happens? So here you do it for different divisions. So for division L, so what will happen for division L is that it will sell 160,000 units externally and also 120,000 units internally. So now remember that contribution is 16, but only if you consider also the selling and distribution costs. which means that if you are looking at internal, it is not actually 16. It is 20 because they don't incur this $4. So contribution. So for the transfer, these are 120,000 units multiplied by 20. That's what they will get for. That's what they will get for the transfer. But for the external, they will be having 160,000, multiply that by 16. So that is the contribution. So which gives us 4.96. So this is the total contribution. So that's total contribution. Now, we now look at here, fixed costs. Now, fixed cost again, we have 500,000. Which gives us 4.46 as the profit. That's the profit, 4.46. That's division L. Then for division M, so now for division M, remember that for it, the contribution is 26. Okay? 26. And then, so we shall have contribution multiplied by the 120,000. So that's 120. Then fixed costs, 120.
I think fixed costs are 200.
Oh, 200, sorry. Yeah, 200. So that gives us the profit, 2.92. So this is the profit for division M. Okay, so now the question is, okay, I don't think they asked for this, but I want us to do it just to bring the other discussion we have been making. So this profit is if division M buys from division L. Okay, that is the profit if that's what happens. Now I want us to do this again, but if division M were to buy externally. So if division M buys externally, so I'm going to just copy all of this because we are going to just edit this and that. So first of all, that means that there's not going to be any profit here, any contribution from the transfer. That's the first thing that will happen. But then also, externally, we shall still sell. Okay, we shall still sell the 120, the 160,000. So that will still stay. That will be 2.5. Now the fixed cost is 500,000. There is a sort of question whether these fixed costs would stay the same. But fixed costs being that they are usually not changing based on volumes, yes, we shall say that they are going to stay the same. So that will give us a profit of 2060 for division A. Then for division M, now its contribution is not going to be 26. Remember, this 26 is because they have bought this thing at 40. So the new contribution will be 26, the one that we have now. Okay, we are going to add back this 40 and then remove that 7. Basically, we are adjusting it to not be 26. So here is let me do it here. 26, if you add back 40 and remove that 7, contribution now becomes 29. So you can see that division M benefits from actually buying outside. That's why you can see that its contribution is actually increased from 3.12 to 3.48. And you can see that for it, the profit increases if it buys externally. But now, the total profit, which is the one that the group is concerned about, in the first instance, it is this plus this, which gives you 7.38. But then if you consider it now here, now it becomes only 5.34. So that's actually what it means. That's why when we did the first part, we said that they should actually transfer. Because when they buy externally, the group loses $17 per unit. Okay, I want to hope that you have understood the calculations. If you have any questions, you can ask before we proceed to the next part.
It's okay. I'm following through.
Okay. Now, the other part of this question, please remember this part was not part of it. So like, don't waste time calculating it in the exam. I was just showing you the implication for the group and for the individual entities. Now, the other part is asking us to discuss the problems which arise if the transfer price remains unchanged and advise the divisions on a suitable alternative transfer price for component L. Here they are trying to suggest, first of all, the issues, but also what is the suitable transfer price. So now here the problems, the biggest problem is actually what we call goal incongruence. It is the biggest problem with transfer pricing, where the goals of the division and the company as a whole are misaligned. Because the company as a whole wants to make profit, maximize profits, and for it, it's better for them to transfer internally. Whereas for division B, or division M rather, the goal of maximization of profits would have it buy externally. And now, because what happens is that the profits that they would have made by buying externally are reduced And those profits end up going to division L because it's selling at 40, whereas they could buy at 37 from outside. So that causes them to not have alignment on the needs, on the goals, so that could create uh, something like uh, disenfranchisement, somebody being disgruntled, and all that. So now that is the problem, and you're going to just see how they word it out. This guy describing how division M will not be happy that the profits are not maximized on this end because the group as a whole, blah blah, those kind of things. And then they will say how division M should should at least be able to receive the component from division L at 37 as a minimum, because it means, whenever there's an external supplier who can give it to you at 37, then internally, if they are not giving 37, then it means that you are going to buy externally. And since we have seen that it's not profitable for buying externally, then it should be sensible that they charge that the price that should be consequential in this case should be 37. Okay. So now, but 37, the if you look at the price, okay, 37 is one of them, okay, as the external supplier gives this, but also another price, usually the price which relates to all the costs that they are incurring. If you look at division L incurs, as we said, 20. Okay, it incurs $20, and then it makes a contribution of 16. But the idea is it would make sense if they at least will do, because this is, if you get this 20 plus 4, that's 24. Okay. Ideally, if you charge, if component L were to go for product M at 24, that would be a good price. But at least maybe on the very least, they should charge them 40 minus this 4, because they are already charging them 40, yet they are charging the same 40 outside, where they are also incurring selling and distribution costs. So perhaps they should charge them 36. Okay, so 36 here, because this one removes the external, removes the selling and distribution costs. So this is a sensible price of 36, but at the very least, if they can't do 36, they do 37, which is the one that external people are providing. So that's how you are able to come up with a price that is sensible for this transaction. So that is actually how that would have been calculated. Is it clear and understood?
Yeah, it's okay.
Please note that there are several other configurations of transfer pricing that can come. If you check the video that I made on transfer pricing, you can see that we mentioned things like, if there is no alternative out there, like here in this case, there was an alternative out there, so that's another story. Or if the group policy does not allow you from buying wherever you want, and policy says that you should buy within the group, if the demand external is not a lot, because there's now, like capacity here, for instance, if our capacity was actually not 300, but rather 160, then we would ask ourselves, should we supply product division M, the 120, and only supply the external people the remaining 40? Now that would depend on what we are charging the external people and what we are charging component division M. So there are so many other things to consider, but ideally the logic is the same. You have to just think about it in terms of fairness. Okay, so that's the point here, fairness. Okay, so that is it for that. Let me see which other question we can do. Okay, let's do this question, jump performance appraisal. Uh, it has some aspects of responsibility accounting where you basically give somebody a bonus or reward or recommendation based on what they are able to control. So if you look at the question, they are saying calculate the amount of bonus that the manager should expect to be paid for the latest financial year, and then discuss to what extent the targets set are controllable by the local manager. So you need to make a case for both sides. So usually this one can be biased on one side. You can make, because these are 9 marks, so you can make 3 points for one side and maybe 4 for the other, or you can make 3 points, something that comes from the scenario that we have. And then now describe methods, 2 methods as to how manager with access to the accounting and other records could unnecessarily manipulate the situation so as to gain greater bonus. So it's about performance management. And when you now look at what is told about this, they are saying that Jump has a network of sports clubs which is managed by local managers reporting to the main board. The local managers have a lot of autonomy and are able to vary employment contracts. So remember, there's a part which is asking us about controllability. So we need to read when we are saying what we are going to answer. So they have a lot of autonomy, the local managers, which means that they have so many things they can control. They can vary employment contracts with staff and offer discounts for membership fees and personal training sessions. So they also control their own maintenance budget, but do not have control over large amounts of capital expenditure. Now, this is something they don't control. So probably when we find something that is related to this, we shouldn't penalize them on that. A local manager's performance and bonus is assessed relative to 3 targets. For every one of those targets, there is in a quarter $400 added to the manager's bonus, which is paid at the end of the year. Maximum bonus per year is therefore based on 12 targets, 3 targets in each of the 4 quarters of the year. Accordingly, the maximum bonus that could be earned is 12 times 400, which is 4,800, which is 40% of the basic salary of the local manager. And the year end is 31st March. So then they give us, this is what they're telling us. So they are giving us the quote at 30th June, then the 30th September one, then 31st December, and the one of 31st March. So the members are there for each of the quarters. The member visits are there. Personal training sessions booked are there. Staff days, staff lateness days, and days in quarter. So, first of all, if you look at here, you can check whether there is anything that they can't control. But so these are the agreed targets. Staff must be on time over 95% of the time. No penalty is made when staff are absent from work. So then on average, 60% of members must use the club's facilities regularly by visiting at least 12 times per quarter. Then on average, 10% of members must book a personal training session each quarter. So those are the things that we are going to assess. So we are going to basically check these. So that's going to take this. So that's what we have. So remember the three metrics we have to deal with. Staff, let me also take them just so that we have them in the same place. Okay, so we have our metrics. So staff must be on time. So we are going to put here Q1, Q2, Q3, and Q4 for the different quarters. Then now we first check staff on time. So we need to check because remember they are 450 days, but of those, these are 20 where they were late. So we need to know when were they, how much were they on time. So it means that if they were late for 20 times, that means that they were on time for 30 days. So staff on time. So you can say 450 minus 20 over 450. Okay. So that's 95%. Okay. That is 95%. And remember they said it has to be 95% on time. So uh so we are going to try to okay, so in quarter one, that is matched. In quarter two, we have 480 minus 28. Yes.
Then that one does not pass.
This one doesn't pass. Yes. Then here 470 minus 28 divided by 470. This one doesn't pass either. And then the fourth quarter, that is 480 minus 20 divided by 480. 95.8. Now, we can put here a column for bonus. Remember, bonus is 400. If we go back to this, they're saying that for every one of these three targets that is reached in a quarter, they give 400. So means that here the bonus will be 400 times 2 because it was made twice. Okay. Second one, member must use the club's facilities regularly by visiting at least 12 times per quarter. 60% of the members. So let's look at the visits. So these are the training sessions booked, but the visits are 20. So 20. Now, remember they said 60%. Okay, 60% of members must use the club's facilities at least 12 times per quarter. Now, if these are 3,000 people, and these 3,000 people visited 20,000 times, so we just need to know how many visits per person. Okay, so you can try to divide this. For example, here, 20,000 divided by 3,000, that gives us 6.67 visits per person. Or what you can do is that you say, okay, of these members, the 3,000 members, these are two ways of calculating it. Okay, so of these members, if you do 60% of the 3,000 members, can they, if they each visit 12 times, how many do you reach at? Because here, if we do it other and you say, because here you can see this is showing you it's not reaching, but if you do it like this and say 60% of the 3,000, if they visited 12 times, that would make 21,600 visits. Okay? But the visits that actually were actual is 20,000. Okay? And you can now tell from here that this was not achieved. So achieved. So I'm going to say if this is just because we are here, this is not what you're going to do in the exam. In the exam, you just look at it and say not achieved. You put no. But if the actual visits are more than this one we have calculated, let's say they visited yes, or we say no. Okay, so in this case, this was not achieved. Then we can do it again for this. Remember, it is 3,200 now, so 60% of 3,200 multiplied by 12, if that should be 23,040, but actually was 24,000. So here they achieved it. Then for the third quarter, 3,300 times 12 times 60%. So that gives you 23760. And the right number is 26,000. Even here it was achieved. And in the fourth quarter, that is 60% multiplied by 3,400 multiplied by 12. That is 24480. And here we have 24,000. So here we didn't achieve. So this is also just 2 times. So 2 times 400. Okay. Now we have finished the second one. Now we go to the third one. Personal training sessions each quarter. On average, 10% of members must book a personal training session each quarter. So that one also you can do it the same way we have just done. Because the actual training sessions, they are here. So if each one booked one session, okay, 10%. So if we say training session, personal training sessions. So if we say again, if 10% of these 3,000 people booked a session, that would put it at 300. What are the actual sessions? In this case, it is 310. Okay, so it means
Yeah.
that this one passes, right?
Yeah.
Yes. Just to copy, because we have this formula already working, this is passing. And
But
then, yes.
no,
Then for
it's okay. But they said on average, 10% of the members must book a training session
yes.
each quarter.
Mm. So that means that if you are looking at 3,000 people, it means that on average the session should be 300 if 10% booked. That's what here we are saying.
Okay.
Yeah. Yes. Then, oh, I think I have changed something. Yes. Okay. Then we go for quarter two, 3,200. So we have 10% of 3,200. So if they booked, that will be 320. And this is 325. So this one also achieved. Then for quarter three, 10% of 300, that is 330. And so here I have 310. So that means they didn't achieve that. And then for quarter four, 10% of 3,400, that's 340. And here they actually put 339. So they also didn't achieve. So here only 400. So that's how we do this. Then we can now get total bonus. Total bonus here will be $2,000. So that's how you could calculate that bonus based on the different aspects that were told. Oh, this is not only one, actually, there are two. This and this. So times 2. So 2,400 total bonus. Okay. So then the second part of the question was asking us to discuss the extent to which the targets that are set are controllable by the local manager. So now, so we are going to actually to say how controllable the targets are. And here they are saying we should make a case for both. So we are going to say here controllable and then non-controllable. You can choose to do, because we are looking at these three targets. So you can first of all look at staff being on time, then you say how controllable and how uncontrollable. Then you go club facilities, how controllable and uncontrollable, and so on and so forth. So, but here we are going to first say, how is staff being on time? Time controllable by the manager. Okay. So now here, this we can say the manager can control this. Okay, by ensuring strict guidelines for tardiness are followed. For example, warning, like, things that can be done by managers to control people coming on time. Okay. And you see, the question also told us that this manager actually is like he has a lot of autonomy. He can vary employment contracts, offer discount for memberships and personal trainings. So he can vary employment contracts, which means that he can change the contracts where he can vary them so that he can decide which are going to be like the rewards and the warnings. Okay, rewards for tardiness. Okay, you say because they can vary employment contracts and can therefore incentivize staff or put stringent warnings to ensure tardiness. So that is how controllable that is. But on the other hand, people may have other issues happening. Okay, so staff being on time may not be so controllable because some staff may have personal problems, things like family and the like, that may hinder them from being on time 90% of the time. Okay, like if you think about it, even on for your case, may not be possible for you to be on time, like you always be at work exactly at the time that you're supposed to be there 90% of the time. You'd be able to manage, but there's sometimes when you wake up, like maybe somebody is sick, you need to first go to hospital. Maybe you didn't have a good night because you have relationship problems, your wife, something really. Okay, and therefore you are not able to make it on time all the time. And I'm thinking now the best way to do this is to actually look at one thing: staff on time, and then you clear it. Then you go now to the other of members using the facilities regularly. So here, you can say that the manager can control this since he has the authority or the autonomy to offer discounts on regular use of facilities. This can incentivize the members. Okay. However, okay, the other side is usually like even if you give them, even if you give the members maybe discounts and everything, other factors may hinder members from utilizing facilities regularly. So things like the work schedules, okay, things like maybe weather, seasons, like maybe during winter, they may not want to come. Then maybe state of health, like they may not be able to do, for example, gymming every day, or because we are trying to have them come. Remember, this point was to try to make them come uh, at least 12 times per quarter. If you are looking at a quarter which has 3 months, so 3 months divide by 12, or rather 3 months, each one having 4 weeks. So if you divide by 12, that means as at least you are saying every week they are coming. It may not be very feasible for some people. Then the third one. So basically, remember we're supposed to say whether the manager has some kind of control. So here manager can control really. Because if you can't control your staff to be on time, then there may be a problem. But here, manager can only partly control this, which means that it will be disgruntled, or to the manager will be disgruntled if you are giving him bonus based on it, because it's not really in their control. Then the third thing, personal training session. Even here, it's the same explanation as before. Manager may control through discounts, okay, because they told us that the manager can provide discounts. Manager can give discounts on personal trainings. Okay. However, again, the members may be busy with work. Okay. Busy with work. Perhaps the personal trainings are expensive. Okay, which I would suspect. So perhaps the members may want facilities to be improved, yet the manager cannot or does not have control over capital investments. And therefore, again, here manager can only partly control. So basically, that's what they wanted. So these are the 9 marks. So ideally, they are splitting them 3 marks per section. So that is the second part of the question. And the last question just wants to talk about how a manager with access to accounting and other records can manipulate the situation so as to gain a greater bonus. So here they are trying to say, how can the manager try to beat this system? So manager manipulation. So the first thing that the manager can do, remember these things are done per quarter. So you can see that, for example, in this first quarter where I'm not reaching, I am at just 20,000 when it should be 21,600. And here I am at 24,000 when I have 20,040. If I shift some of these things to the first quarter, I may hit the quarter first. So we may experience what they call it cutoff. Okay, where a manager can move items between the quarters to ensure that targets are hit for all quarters. Okay, so there is no need for you to have, for instance, here these extra 10 sessions here when you can actually put them here, and this one becomes 320. Then you pick some of them here, put them here, and you have these ones also achieved. Because if you look at it, if you were to sum all the personal trainings that you should have in a year, that is 1 to 90. And then if you do the same thing for the actual sessions, 1 to 84. It means that here you are left with just few to finish the whole year. It means at the very least, at least 3 of these quarters you can be able to achieve if you shift things here and there. So that's the problem. That's the first thing the manager would do. Would try to play with cutoff. Then the other way that the manager can do it, he can reduce prices too low to encourage personal trainings and facilities, members use of facilities. So this would work. However, it will bring losses to the company as a whole, which is the same thing which we talked about, which you call go incongruence. Because again, the manager is trying to achieve their goals at the expense of the company's goals. So when the company's goals are not aligned with the goals of the manager, that is also not being congruent. So that is the 2 ways that the manager may manipulate. So I don't know if you have any questions or it's clear.
No, it's clear.
Okay. All right. So we are going to stop here for today. Have a good night. See you tomorrow. Tomorrow you can also, if you can, send some questions that you want me to do so that we do those. If you don't, I'll pick other questions and you do. Good night.
All right. Good night.